Interest rates, they're at the heart of every conversation about buying a home in the UK, and they can feel a bit mysterious if you're new to the world of mortgages. It's a phrase you hear every time you talk about mortgages in the UK. But what exactly are interest rates, and why do they matter so much when you're thinking about buying a house? But what do these rates actually mean for you as a home buyer? How do they affect your monthly payments? And what should you be watching out for? Let me break it down in simple terms so you can feel confident when making one of the biggest financial decisions of your life. First, think of interest rates as the price of borrowing money. When you take out a mortgage, you're essentially renting money from the bank, and the interest rate is what you pay for that privilege. When the Bank of England changes its base rate, it isn't just economists who pay attention. The effects ripple out to banks, lenders, and ultimately to you. The banks you're borrowing from, they're watching closely too. They adjust their own rates based on what the Bank of England does, and that impacts the deals they offer to customers. If the Bank of England raises the base rate, borrowing becomes more expensive. Lenders pass those higher costs on to you, the borrower. For you, that means your mortgage payments can go up, sometimes by a little, sometimes by a lot. Even a small increase can make a noticeable difference to your monthly budget. And if the base rate falls, you might pay less each month. Good news for your wallet. Lower rates can free up money for other things, like savings or family outings. Now, there are two main types of mortgages: fixed rate and variable. Each one reacts differently to changes in interest rates, so it's important to understand the difference. If you've got a fixed rate mortgage, your interest rate and your monthly payments stay put for a set period. This gives you peace of mind, knowing exactly what you'll pay each month, no matter what happens to the base rate. You're protected from sudden changes, at least for now. Fixed rate deals usually last 2, 3, or 5 years, after which you may need to renegotiate or switch to a new deal. But with a variable rate, your payments can change whenever rates do. This means your monthly costs could go up or down, depending on what the Bank of England decides. If the base rate climbs, you'll see it in your next bill. It can be unpredictable, so it's important to budget for possible increases. Let's put this into perspective with a real-world example. Imagine you've borrowed $200,000 to buy your home. That's a typical amount for many first-time buyers in the UK. If interest rates rise by just 1%, you could end up paying thousands more over the life of your mortgage. That extra money adds up over years, affecting your long-term financial plans. That's money you might have put towards your child's education, a holiday, or even home improvements. Every pound counts when you're managing a household budget. But it's not all doom and gloom. Interest rates can go down as well as up, and that can work in your favor. When rates drop, you can save. Lower monthly payments mean more breathing room in your finances, and sometimes the chance to pay off your mortgage faster. Some people even choose to remortgage, basically switching to a new deal, to take advantage of better rates. This can help you lock in savings or find a deal that suits your changing needs. It pays to keep an eye on what the Bank of England is doing and to review your options regularly. Staying informed can help you make smarter decisions and avoid nasty surprises. So, what should you do as a potential home buyer? How can you prepare for changes in interest rates and make sure you're not caught off guard? Don't just look at house prices. Pay attention to where interest rates are headed. A great deal on a house can quickly become expensive if rates rise unexpectedly. Speak to a mortgage advisor, crunch the numbers, and plan for some wiggle room in your budget. It's wise to prepare for higher payments just in case. Interest rates are always moving, but with a bit of knowledge, you can stay one step ahead. Being proactive and informed puts you in control of your mortgage journey. That's how UK interest rates impact your mortgage, and why it's so important to understand them before you buy. If you found this helpful, don't forget to subscribe for more clear explanations on all things home buying. Your journey to home ownership starts with the right information.